Good morning, everyone. We have just completed our test in financial management as well as submitted our first assignment package for 20%. At this point now, I believe I've marked all of them, although maybe a couple of the tests still need to be looked at. Going forward, we will be looking at cash flow. So this is week 6, where we will discuss cash flow and how what we need to know about it as future managers. So I'll talk about cash flow here today. We'll also look at working capital and how that works. We'll talk a little bit about credit and borrowing and lending activities. And then, of course, we will go into our in-class activity. Now, just so you know, I will go through the in-class activity during this particular class. This week is technically the week that you will be writing your test. So next week, we will have a double lesson if you are in my Monday class anyways. We will have a double lesson where we will go over not only cash flows, but next week's in-class activity as well. So we have been introduced to these four financial statements quite a bit. What I need you to understand now is that we will be looking at the cash flow statement. So you might see the acronym CFS in some of these things, and CFS stands for cash flow statement. And this is the process of moving cash in between accounts, paying bills, accepting revenue, and it is not the same as an income statement. So an income statement will state exactly how much money we may make over a period of time, not how much money we may collect. And this is quite different. So when you think about a car dealership as an example, many of us, when we purchase cars, we don't pay for the car up front. Rather, what we do is that we have a payment plan. So while you say you might have made $40,000 off the sale of a car, you might take 7 years in which to collect the entirety of that $40,000. Very different when it comes to cash flow statements versus income statements. Income statement is, yes, how much revenue you've earned. Cash flow statements is what portion of that do you get to have and to use. Okay. So cash flow is king, and I like this because it kind of tells you exactly the importance of cash and why we need it as a business. The number two reason for businesses failing in the United States is insufficient capital. So capital means cash, the ability to access money. That's capital. So it's a major factor in the success of many businesses. It is precisely the reason that companies sell stock, is to increase their cash flow. They need money in which to grow, in which to pay their employees, in which to research new technologies. So the 4 rules of cash flow is that growth sucks up cash, so it costs a lot of money to grow. You need to have a cash flow projection. So where do you expect your money to be in a few months from now at the end of the year? Understand receivables. So we talk about accounts receivable a lot in accounting, and accounts payable. This is money that's owed to you or money that you have to pay. Every dollar in accounts receivable is a dollar less than of cash available. So while on a balance sheet, an accounts receivable, it's a positive account. It looks good because that's money that we're going to see. Accounts receivable on a cash flow statement literally shows us that that's money that we should have in our pocket and still are waiting to get it, and therefore money that we do not have to spend. And the number 4 rule, of course, is cash is king. So profits are not cash, they're accounting. Cash flow is not intuitive. So basically, just because that you have sold $100,000 in rooms revenue in a month doesn't mean that you get $100,000 in cash. This is up to you to manage. As we said, growth sucks up cash. Business to business sales suck up your cash as well. Because often what happens for business to business is that we give them terms in which that they can pay. And a term would be, and I don't know if you remember this from your accounting classes, 2 and 30, which means your full bill is due within 30 days, and if you pay it before that, you get a 2% discount. or 5 and 90, which means that they don't need to pay within 90 days, but if they pay up in full before the 90 days, they'll get a 5% discount. Now, the reason this sucks up your cash is that we give them these long terms that for, let's just say I have $100,000 owing to me, but I've given a company 90 days in which to pay me. In that 90 days, I now need to pay for all the labor, the food, the beverage, the sheets, the housekeeping costs, all of the costs associated with making that $100,000 before receiving a dollar of it. And if you're a hotel and you think about the labor and you think about the food costs and beverage costs and everything else, what are we keeping? 20%? Maybe? So I might have to spend $80,000 now in which to hopefully receive $100,000 within 90 days. Now I hope you start to see the issue with cash flow. Inventory sucks up cash as well. Working capital, which is the amount of money you have to spend, is your best survival skill. And receivables is a 4-letter word, which means shit. And bankers hate surprises. Okay. So a couple things that we like to talk about and how cash flows is a little bit different. So typically in accounting, we use what we talked about as accrual accounting, which means revenue is recognized or recorded when it's earned, not when it's paid for. Expenses are recognized or recorded when they are incurred, not when they're paid for. And it looks at net income in a time period, regardless of if payment is received or not. So you don't actually have to have any money in the bank for an income statement to look really positive and favorable. Now, a cash flow statement, we have to use a cash-based accounting, which means that revenue and cash inflow is only recognized when you have that cash in your hand. And expenses are only recognized, and by recognized, I mean it's actually going out of the account or into the account when you pay money for things. So it relates to the flow of cash in a business and is regardless of the effect of net income. Very profitable companies go bankrupt because they can make a lot of money, but they have debts that they cannot pay because they haven't collected on it, because they've made bad cash decisions. So a couple things. So when we're talking about assets, cash inflows happen in a couple different ways. So these are inflows. So inflow means more cash in your account. So if you have a decrease in an asset account, you typically have more cash. So basically the understanding is that if you pay cash for something or you sell an asset, you have less cash. An increase in the equity account. So a cash inflow will take place if you sell shares of your company or holding on to retained earnings. So one, I'm selling a bit of my company and somebody will give me cash. Great, that's easy to understand. Or I'm holding on to retained earnings. So I've made good money, I've already collected the cash, and although I'm supposed to give this money out to some of my shareholders, people who own the company, I'm holding on to it. And basically what we're looking at for here is the end result. Do you have more cash in your pocket or less? And an increase in a liability account. So accounts payable is a liability account. It basically means I owe somebody. If I increase an accounts payable, that means instead of giving you my cash right now, I'm going to owe you for another day. So that's going to increase my cash. A cash outflow takes place when there's an increase in assets accounts. So you purchase assets using cash, or a decrease in equity accounts. So dividends. So if I pay a dividend, now a dividend is essentially a reward or a bonus for anyone who owns a piece of my company. It is part of that retained earnings whole thing where retained earnings is dividends that I haven't paid out, essentially. So they come in two forms. I hold on to it, retained earnings, or I give it out, dividends. And it's cash either way. Either I get to hold it or the other owners get to have it. Or a decrease in a liability account. So a decrease in a liability account means I had this accounts payable. I had this money that I owed to somebody. And instead of keeping that, I decided to pay some of that amount. So that would decrease my cash flow. easier to understand when you're looking at it. So this here is something that we could do together, and we will do together in our class, but I'll just take a look at it real quickly. So what they're saying here is that their current assets, they have cash of 18,000, and then they have cash in 2017 of 22,000. That would be a cash inflow of $4,000. So this is essentially a horizontal analysis looking at 2 different years, and all we're doing is saying, we have more cash or less cash? So if we have more inventory, which it shows right here, that is usually a cash inflow because inventory costs money to buy. Accounts receivable, if we have more accounts receivable, that will be a cash outflow because here instead of collecting money, we've decided that more people owe us money, 300,000 instead of 280. Prepaid expenses, we had $55,000 in prepaid expenses. Now we have 60. That's a cash outflow of $5,000 as well because we actually have more expenses that we've paid in advance, and we have to pay those expenses with cash. So that gives you an idea. Accumulated depreciation is it's always been a complicated term. Essentially, any accumulated depreciation will give you money. And we'll go over that in a minute. So, why does depreciation add to cash flow? I'm trying to think of the easiest way in which to show you how this works exactly. But what's happening, it's a non-cash expense. So basically, let's say you own a fleet of delivery trucks, okay? By law, we have to show that those trucks, they're being used every single year. Let's say I bought them for $1 million. They are no longer worth $1 million after a year full of use. So let's call it $900,000 they're worth now. So $100,000 in value they depreciated. So we like to gradually reduce the recorded cost of the asset over its useful life. The trucks I bought are no longer brand new, they go down in value. Thus, depreciation affects cash flow by reducing the amount of cash a business must pay in income tax. So when I reduce something by $100,000, I take that away from my company. So on an income statement, that shows how much money I make. Let's say I had that $100,000 and I was going to have a net income of $100,000, but because of this depreciation, it lowered it to zero. So I'm making no money. Therefore, I'm paying no tax, and I have no obligation to pay any cash. And if it's causing me to not have to pay cash, it's a cash inflow. It's saving me cash, saving me money. So it's a complicated way to look at it. Easier way, if you just want to try to do this, depreciation just adds to cash flow. And if you just remember that rule, can get through the problems, no issue. Again, I'm going to do this in class, but something you might want to look at here, so we'll go over just a few of these liability ones. So liabilities are interesting. In 2016 to 2017, my liabilities went up $20,000. Now, if someone told me that I now owe $20,000 more than I did last year, you automatically think you're doing worse off. And you are, but according to a cash flow, that's $20,000 that I didn't have to pay. I now have $20,000, more in cash to use. Notes payable went up $15,000. It'll be a cash inflow of $15,000. Same thing with accrued expenses. I had $18,000, now it's $20,000. Accrued expenses, does that mean I'm putting money away for these expenses? I've had to put more money away by $2,000. Therefore, that's going to be a cash outflow of $2,000. So it gives you an idea that it's not as easy to understand. It's easier to understand an income statement than it is cash flow because sometimes the results are opposite than you might think. Okay, so within a cash flow, there are 3 different styles of activity or transactions. There's operating activities, and now this is where we come in as management and workers within the company. This is profits for the years, this is depreciation. These are all these things that we do, that we can really impact. There's also financing activities. So this could be paying off some long-term borrowings. This could be having a share capital or paying some dividends to some of our investors. And there's also investing activities, which is typically a negative because we are investing into the company, which means we're usually paying cash to buy more property, plant, and equipment. Okay? So first we'll look at how these work. So the very first information on a cash flow statement is your operating activities, and that's what you start with. And it shows the results from the day-to-day business. Then we look at our investing activities, which means how much cash has been used to generate or are used on investments into the business. This is typically negative because we invest in things that help us do our jobs better, but these things cost cash, cost money. So it could be new technology, it could be new labor, it could be research or equipment, a new building or a truck. These are the things, and they're typically a negative cash flow impact. And then there's financing. So financing can be both positive or negative. It shows activities used to fund the company. So if I sell some stock, I get cash in return for that. That's a positive. But if I pay out a dividend, that's a negative because I'm paying out that cash. Operating activities include a bunch of different things. Could be receipts from the sales of goods and services, so actually selling the product in which your business operates on. Paying interest payments. So if you have debt, typically your debt has an interest payment, so you have to pay that. On the other side, if somebody owes you money, you might have an interest payment coming to you, so a bonus. So interest payments can be both negative or positive, depending if you are paying a bank or a customer is paying you. Income tax payments, that's a negative. No one likes to pay that. Payments made to suppliers of goods and services used in production. Salaries and wage payments to employees, that's a cash outflow. Rent payments, cash outflow, and any other types of operating expenses. So what we'll do here in class is that we'll go through these together, and what I would say is, okay, if I was purchasing equipment, is this a financing or an investing activity? So this would be an investing activity because we're buying new equipment. We're investing into the business. And this would decrease our cash flow because we're obviously spending money to get this equipment. If I sold shares of stock, this would be an investing activity, a financing activity. And basically what's happening is this would be an increase to cash flow because in lieu of having more of my stock, I am trading it for cash. If I sold my office furniture, this would be a financing activity. This would be an increase to cash flow because I'm obviously receiving some cash from the sale of that office furniture. So we'll go through those as well. And these are just the answers, which I will leave you with, and you can review on your own time. So working capital. Working capital is the value of current assets. Or in net working capital's terms, it's the excess of current assets over current liabilities. So it's basically if I had to pay all of my specific short-term debt off, how much money do I have left? So it's important as this is the potential for available cash. If you have more current liabilities than current assets, you need to think about financing activities that will allow you to survive. Because if you do not have enough current assets, cash, to pay off your current liabilities, then you might go bankrupt. So you either have to sell a piece of your company, or you have to maybe contact whoever you owe money to and figure out a different payment schedule. So there are things that we need to understand on how to work with working capital to ensure that we have enough money to get us through year over year. Seasonal industries specifically, which many of us work at, or even just industries that have they have busy seasons and really slow seasons, are things that where we really need to focus. A gas station probably really doesn't have a peak season versus a slow season. People are always driving and always paying money. A hotel with a beautiful summer in Muskoka, but a horrible February, we know in February we're not going to be bringing in much, if anything, if we're even open. But we still have all of the costs associated with being a business. So working capital is a very important term, and we will need to understand that as we progress in our careers in our future. These are some of the basic financing for a business with inefficient cash flow. So if you don't have enough money, as in life, you have to borrow. Very few of us get away without borrowing. I had to borrow for my car. I had to borrow for my home. And when you think about it, I own although I can say, hey, I have a vehicle and a home, I don't actually own the majority of either of those. The banking institutions do, which is really sad to think about. We also want to think about ways in which that we can borrow money. So many of you are using OSAP, which is the Ontario Student Assistance Program for college and university. And if you're an international student, you don't have that. So you're getting money from your parents, getting money from other banks, lines of credits, things like that. We also have to think about terms and interest. So as an example, OSAP, you pay nothing as long as you are in school. But once you are out of school, I believe the interest rate's probably around 7% or so, which is pretty high. Mortgages are usually around 2.5%, 3%. So that's not that bad. You know, if I borrow $100,000, I'll owe $102,000 by the end of the year if it's a 2% interest rate. Credit cards are 25 to 30%, 21%. They're outrageous. So if I put $1,000 on a credit card, the next year I owe $1,210. If it's a 21% interest rate, it's too much. So a couple things that we like to think about is the 5 C's of credit analysis. We all will need to borrow money one day. And how we borrow money and the price or the rates and the terms in which we borrow money may really dictate if we are financially successful. You do not want to borrow money at an outrageous credit or interest rate because it will haunt you and will haunt you for quite a long time. How we look at who is good to lend money to is usually by using a credit rating, which we all have, and you can look yours up. They have 5 different C's in which they analyze for credit analysis. The first one is character. So there's a moral integrity of the credit applicant. Do they pay their bills on time? Have they ever been arrested? Is there any fraud or any kind of thing that's been on their record that should not be? Have they ever declared bankruptcy? Those things. Number 2 is capacity. Does the borrower have the financial ability to pay? So this would be your paychecks and your income statements of the business saying, are they bringing in a sufficient amount of money in which to pay these off with whatever term that we've decided on, 5 years, 10 years, 20 years. Capital. What is the general financial condition of the borrower? If their working capital is negative, which means they don't have enough current assets to pay off their current liabilities, you will probably not get a loan or credit. Collateral. So do we have something that we've signed off that if we can't pay, you may take ownership of? So has the borrower pledged assets as a security? A lot of people will start a business and they'll use their home as collateral. So if the business fails, the people who help fund the business can now sell that business owner's home and take whatever value that they are owed still. And conditions, the operating and financial condition of the borrower. So here's a couple little interesting things is that if you were to borrow $10,000 from OSAP, so if you have OSAP right now and you're watching this video, this link here that's in the PowerPoint will show you how much you can expect to owe. If you want to pay off your $10,000 loan from OSAP and to be paid off in 5 years after school at a 6% interest rate, which is probably good, you will pay $210 a month and you'll pay back a total of $12,600. So you will pay an extra $2,600 on that $10,000 to go to school. If you pay the same loan off in 10 years, which is the industry average, you will only have to pay $126 a month. So a lot of people will say, well, I'd rather pay $126 a month than $210, even if I have to pay it for longer. But the interest is still calculating. So every year the higher the balance that remains, you still have to pay interest on that. You will actually pay $15,120, 51.2% more than what you borrowed. This seems to be a pretty bad investment. So if you can scrounge together the extra $84 a month, you will save yourself over the long term almost $2,600. It is well worth doing. And that brings us to our problem. So our problems are going to look like this. So this is the information that will be given to you. What's going to happen is that they will look at specific balance sheet information as well as some of the stuff from the income statement. The balance sheet will show you what has happened to some of our current asset and current liability accounts over time. And we're really only concerned with the current asset and current liability accounts because that's what affects cash flow. So they're going to tell you if they either increased or decreased and the amount of money in which they've done so. And then we need to decide how does that affect our cash flow. And this additional information will be used to figure out what kind of money is coming in and what kind of money is going out as well. So I'll pull up the Excel sheet that we'll be using. So this will be the in-class activity here. Let me zoom in a little bit. All right. So what this is saying is that this is the balance sheet information for a resort hotel. It reflects the changes to current accounts that occurred over the annual operating period between December 31st, 2019 and December 31st, 2018. At the end of December 31st, 2018, so the first day of 2019 technically, we had $15,000 in the bank. So cash balance December 31st, $15,000. The ending cash balance at December 31st, 2019 is $47,600, resulting in an increase of cash flow of $32,600. So $47,600. So we have technically already looked at the answer. So this is the cash balance we started with. At the end, we have this much. At the end of years, it's easy for us to look at our cash or our bank account and see how much. What we are doing now is trying to determine how did we make that $32,000? Where did that money come in and come out? So, first ones, we start with our credit card receivables. Credit card receivables have decreased by $1,800. So we go down here, credit card receivables. What we will be doing in this whole thing is trying to determine, is it a positive or a negative to cash flow? That's all we're trying to do. I'm just going to make these numbers real quick. Okay. So if our credit card receivables has decreased $1,800, that means that somebody owes us less money. If somebody owes me less money, that means that they would have had to pay me money. So that goes an increase of $1,800. Our accounts receivable increased by $2,500. So this is the way you need to look at this. We have a cash account and we have an accounts receivable account. I only care about cash. That's number one. Accounts receivable basically says that somebody still owes me money and I will get it, but I don't have it right now. So if I don't have it right now, it's negative $2,500 because it's in my hand or it isn't. And whenever it's not in my hand, it's a negative. Inventory decreased by $2,000. Most businesses buy inventory in which to use or sell. So if our inventory went down $2,000, that means that we must have sold it. So therefore, that goes up. Our cash flow goes up $2,000. And prepaid expenses is increased by $1,800. So we have paid for an expense that we didn't need to pay yet. So therefore, we go down $1,800. So this is the confusing part, right? Like when you think about, hey, our credit card receivable or accounts receivable have increased $2,500. somebody owes me $2,500 more, but as far as cash flow is concerned, you have now $2,500 less available to you. Now that you're not going to one day get it, you will one day get it. But right now, if I need to spend cash, I'm not getting it. Okay, current liabilities. Accounts payable has increased by $4,000. So if our accounts payable increase, this is money I owe somebody else. If my accounts payable increase, that means I didn't pay him cash. And if I didn't pay him cash, it means I have more in my hand. So $4,000 increase. Accrued payroll payable and taxes payable. Both of these have decreased by $4,900. If bills that I owe have decreased, that means I must have made a payment. And if I've made a payment, that means it's a negative amount. So these are both negative amounts. And then finally, depreciation expense. So depreciation expense is $100,000. Simple rule, it's always a positive. Depreciation, you add $100,000 on. And now we have to start adding some of this rest. So this is the additional information. So net income was $122,000. So revenue might not be cash, but net income is cash. So revenue is just money in before we remove all the expenses. Net income is how much money we actually made at the end of the year. So net income will be cash and a positive. New furnishings were purchased for $10,000 and new equipment was purchased for $22,000. So I am purchasing things again, and if I'm spending money on something, it's a negative. So this will be negative $10,000 and this will be negative $22,000. And the last two was a total of $44,000 was paid to reduce long-term debt, and cash dividends of $112 were declared and paid. Both of these things are me spending money or my business spending money. One of which was just to reduce some of my debt. I think that's negative $42,000. 44. And this one here was to pay dividends to my ownership. So people who own part of my company get a portion of my proceeds. It only makes sense. So before we do the math, there's a difference between these two numbers. So I'm going to say 47,000 minus 15. We are looking for 32,600. So now we have to start doing some math. Okay. So first one is, what is the total net adjustments to reconcile net income? Which means, what is the total of all of these pluses and minuses right here? So I'm just going to go equals sum, open bracket, and just add all these up. Because it's fine, because you can add negatives and it'll show up as a negative. So if I were to add all the positives and subtract all the negatives, I would be left with 98,600. Which means that when I started with 122 and I add another 98,600 here, 220,600 total. This one has two negatives of investing activities that I've done. I've bought new equipment and furnishings, so negative 32,000. And this one here is $44,000 I paid out, plus another $112,000 I paid out. It's $156,000. So now we have operating activities, investing activities, and financing activities. Some were positive, some were negative. We need to find out the total if I add these up. So 220,600 plus 32 plus 156 equals 32,600. We knew this number already because it was given to us, but we did not know in the manner in which that happened. How did that number come to be? And now we know by looking at these activities and understanding. And what the idea is of this whole class is that you understand that an accounts receivable, when it comes to cash flow, can really hurt you, because I'm giving someone the opportunity to pay me later what I might need today. That's it for this particular week. I hope you all are doing well. So like I said before, if you are in a Monday class, we will not have our class because you're writing your test. The following week we'll go through all this and the next week's lesson. If you're in the Wednesday class, I'll see you at 11 o'clock. And I can go through this a little bit more slowly or give you some more examples. Other than that, have a great week, and I will talk to you all very soon.